Welcome to Wealth Hustle 247 podcast, your trusted guide to financial literacy, business innovation, and entrepreneurial success. Learn how to grow your wealth, make informed decisions, and turn your ideas into profitable ventures.
Want to grow real wealth? In this episode, we break down capital gains and cash flow investing, what they are, how they work, and how to use both for long-term wealth growth. Let's go.
Hey everyone, I know you're all probably thinking about how to, really make your money work for you, especially when it comes to investing.
Absolutely.
We're going on a deep dive today into a topic that's really key to building real wealth: the interplay between capital gain and cash flow investments.
Right.
And trust me, we've got some interesting examples lined up to make this way more exciting than just, textbook definitions.
Yeah.
Ready to level up your investing game.
Absolutely. And what I find intriguing is that many investors, they tend to focus on just one type of investment without fully grasping the power of having both capital gain and cash flow working together in their portfolio.
Yeah, I've actually been guilty of that myself, getting caught up in the excitement of, a potential high growth stock. But
Yeah.
I'm ready to hear why having both is so crucial.
Yeah.
So for those who might be newer to this, can we break down the fundamental difference between capital gain and cash flow investments? Of course. Let's take, for example, a company like Tesla. Initially, investors were drawn to its potential for massive growth. They were betting on Tesla's stock appreciating significantly over time. That's the essence of a capital gain investment. You're aiming for an increase in the asset's value.
Okay, so like if you bought Tesla stock back in, let's say, 2010, when it was around, $4 a share and held on to it, you'd be sitting on some pretty sweet gains today, right?
Exactly. That's the upside potential of capital gain. But on the flip side, Tesla didn't start paying dividends, those regular cash payouts to shareholders, until very recently.
Right.
That consistent stream of income is what characterizes a cash flow investment. Think of it as the reliable workhorse of your portfolio.
Okay. I'm seeing the distinction now. Capital gain is more about that long-term appreciation potential, while cash flow provides a steady, more predictable return.
Right.
But I have to ask, aren't there other investment vehicles besides stocks that fit into these categories? Absolutely. Think real estate. Owning a rental property can be a great source of cash flow, with tenants paying rent every month. And as property values generally tend to appreciate over time, you're also tapping into that capital gain potential. Or consider dividend-paying stocks from well-established companies. They offer that regular income stream and, depending on the company, have the potential for stock price appreciation as well.
So if we're thinking about building a balanced investment portfolio, it sounds like we need a strategic mix of both capital gain and cash flow assets. But why is having both so important? Is it really more than just diversifying your risk?
It's definitely about diversification, but it goes deeper than that. Think of it this way. Cash flow investments, like those dividend stocks or rental properties, provide a financial buffer. They cover your expenses and create a sense of stability. This allows your capital gain investments to do their thing, grow steadily over time,
Right.
without the pressure of needing to sell them off for quick cash.
So in essence, your cash flow investments are providing the peace of mind and financial freedom to let your capital gain investments potentially skyrocket. It's a pretty powerful combination.
Exactly.
But I'm wondering, how do you determine the right balance between the two? Is it a 50-50 split, or does it vary depending on the investor?
That's where understanding your individual financial goals, risk tolerance, and investment time frame becomes crucial. Someone in their 20s with a longer time horizon and a higher risk appetite might allocate a larger portion to capital gain investments, aiming for that aggressive growth. On the other hand, someone closer to retirement might prioritize cash flow to create a more stable income stream. There's no one-size-fits-all approach.
That makes sense. It's all about tailoring your strategy to your specific circumstances and goals.
Yeah.
But let's say you figured out your ideal asset allocation. What are the next steps in creating a truly robust and well-rounded portfolio?
Well, once you have the foundation of your asset allocation, the balance between capital gain and cash flow, the next layer is diversification. You want to spread your investments across different asset classes within each category. This helps mitigate risk and potentially enhance returns.
Okay, so even within my capital gain allocation, for example, I wouldn't want to put all my eggs in one basket, like just investing in tech stocks.
Right.
I'd spread it across various sectors, maybe even consider real estate or even venture capital if I'm feeling adventurous.
That's exactly the idea. And within your cash flow investments, you might consider a mix of dividend-paying stocks from different industries, rental properties in various locations, maybe even explore something like annuities, which are contracts with insurance companies that can provide guaranteed income streams.
So it sounds like the key takeaway here is that diversification is a crucial step in building a resilient portfolio, whether you're leaning towards capital gain or cash flow investment.
Absolutely. A diversified portfolio is like a well-balanced meal.
Uh-huh.
It provides the nutrients you need to stay financially healthy in the long run.
I love that analogy. It makes perfect sense. But we can't just set our portfolio on autopilot and forget about it, right? We need to actively manage it. And I imagine that involves reinvesting those earnings.
Yeah,
Is that where the magic of compounding really kicks in?
you're spot on. Reinvesting those earnings, especially from your cash flow investments, is where the magic of compounding truly shines. Imagine this. You've got dividend-paying stocks generating a steady income stream. Instead of spending that income, you reinvest it back into buying more dividend-paying stocks. Those new shares generate more dividends, which you then reinvest to buy even more shares and so on. It's like a snowball effect where your returns are generating even greater returns over time.
Wow, that's pretty incredible. I can see why compounding is often referred to as the eighth wonder of the world. But I'm curious, are there specific strategies or techniques you can use to make compounding work even harder for you?
Absolutely. One powerful technique is to leverage tax-advantaged accounts like a Roth IRA or a 401k. These accounts allow your investments to grow tax-free, meaning more of your earnings are compounded over time, ultimately leading to a larger nest egg down the road.
That's a fantastic tip. So it's not just about reinvesting, it's also about being smart about where you're investing to maximize those returns.
Exactly. And speaking of being strategic, let's talk about another tool savvy investors use to amplify their returns: leverage.
Leverage. It's a term I've heard thrown around a lot, but honestly, I'm not always sure I fully grasp it. What exactly does it mean to use leverage in investing?
Think of leverage as using borrowed money to potentially amplify your investment returns. It's like having a financial booster rocket strapped to your portfolio.
Okay, that definitely sounds exciting. Can you give me some real-world examples of how leverage works?
Sure. Let's say you're looking to invest in real estate. Instead of paying cash for a property, you take out a mortgage. You're essentially using the bank's money to acquire an asset that generates income through rent payments. As your tenants pay rent, a portion of that goes towards paying down the mortgage, and eventually you own the property outright.
So you're using borrowed money to build equity in an asset that's generating income. That's a clever strategy. But I have to ask, isn't using leverage risky? What if the investment doesn't perform as expected?
That's the critical point about leverage. It magnifies both gains and losses. It can certainly accelerate your wealth-building journey, but it also carries a higher level of risk. If the investment doesn't perform as well as you anticipated, you could end up owing more than you initially invested. It's essential to approach leverage with caution, do your due diligence, and understand your risk tolerance.
So it's a powerful tool, but it's not for the faint of heart.
Exactly. Now let's shift gears and delve into another crucial aspect of optimizing your investments: tax efficiency. This is all about structuring your investments in a way that minimizes your tax burden, allowing you to keep more of your hard-earned money.
This is definitely something I'm keen to learn more about. Everyone loves saving money on taxes, but to be honest, the world of tax optimization can feel overwhelming. What are some key strategies you can employ to make your investments more tax efficient?
Let's start with a strategy specific to real estate. Have you ever heard of a 1031 exchange?
Vaguely, but I'd love a refresher on how it works and how it can benefit investors.
A 1031 exchange allows you to defer paying capital gains taxes when you sell an investment property and reinvest the proceeds into another similar property. Imagine you bought a rental property a few years ago for, say, $200,000, and now it's worth $300,000. If you were to sell it outright, you'd likely owe capital gains taxes on that $100,000 profit. However, with the 1031 exchange, you can roll those profits into another property, deferring those taxes and potentially using that money to acquire a larger or more profitable asset.
That's a brilliant strategy for real estate investors. So you're essentially keeping that money working for you, growing tax deferred instead of handing a portion of it over to the IRS. Are there similar tax advantages for other types of investments?
Absolutely. For those investing in stocks, consider capital gains tax optimization strategies. For example, if you've held a stock for longer than a year, you'll be taxed at the long-term capital gains rate, which is generally lower than your ordinary income tax rate. This can make a significant difference in your after-tax returns, especially if you're a frequent trader.
So holding on to those winning stocks for at least a year can pay off in more ways than one.
Exactly. And don't forget about the tax advantages of dividend stocks. Qualified dividends, those paid by companies that meet certain criteria, are also taxed at the lower long-term capital gains rate. This makes dividend stocks an even more attractive option for income-focused investors who want to minimize their tax liability.
This is fantastic information. It's like we're uncovering all these hidden gems in the world of investing. I feel like we've covered so much ground already, from understanding the fundamentals of capital gain versus cash flow to exploring advanced strategies like compounding leverage and tax optimization. But I think it would be incredibly helpful to see all of these concepts in action, maybe through a real-world example.
You're right, sometimes seeing how these strategies play out in a real-life scenario can make everything click. The source material we're deep diving into today actually features a compelling case study that perfectly illustrates how a strategic investor successfully blended capital gains and cash flow to achieve impressive results.
I'm all ears. Tell me about this investor and their journey.
Imagine an investor starting with $500,000 in capital. Their goal is long-term wealth growth, but they also want to generate a consistent income stream to support their lifestyle. They're comfortable with a moderate level of risk. They're not looking to gamble it all away, but they're not afraid to make bold moves.
Okay, that sounds like a pretty relatable investor profile. Ambitious, but also seeking some financial stability. So how did they approach allocating their initial $500,000?
They took a strategic approach, dividing their capital across 4 different asset classes: rental properties, dividend stocks, high-growth stocks, and land banking.
Ah, I see they're already diversifying their portfolio, incorporating both capital gain and cash flow investments. Tell me more about their specific allocation within each asset class.
They decided to allocate $250,000 to purchase rental properties, aiming to generate a steady monthly cash flow from rental income. This chunk of their portfolio represents that consistent stream of income, providing financial stability.
Makes sense. So they've got their income base covered. What about the remaining capital?
They wisely allocated $100,000 to dividend-paying stocks. These stocks, typically from well-established companies, provide a regular income stream through dividends while also offering the potential for stock price appreciation.
So they're getting that dual benefit of both cash flow and potential capital gains from their dividend stock investments.
Exactly. And to round out their portfolio and tap into more aggressive growth potential, they put $100,000 into high-growth stocks, focusing on sectors like technology and renewable energy.
That's where they're aiming for those potential home runs, the companies that could disrupt industries and experience exponential growth.
Precisely. And lastly, they allocated $50,000 to land banking, a classic capital gain strategy. This involves purchasing land in up-and-coming areas and holding it for future appreciation.
Okay, so they've got a diversified mix of investments covering both short-term income and long-term growth potential. I'm on the edge of my seat. What were the results of their strategy after, say, 5 years?
Their strategically aggregated portfolio performed exceptionally well. The rental property value appreciated by a healthy 40%, increasing their initial investment to $350,000.
Wow, that's impressive. So they're benefiting from both the steady rental income and the appreciation of the property value itself.
Exactly. And thanks to the power of compounding their dividend stocks, we're now generating an annual income of $5,000. Remember, they were reinvesting those dividends, buying more shares, and those new shares were generating more dividends. It's that beautiful snowball effect in action.
It's amazing to see how those small, consistent reinvestments can lead to such significant growth over time.
It is. And they're high-growth stocks. Those performed remarkably well, increasing by an impressive 60%, bringing their value up to $160,000.
Okay, so they hit some home runs with those high-growth stocks. What about their land banking investment?
That proved to be a smart move as well. The value of their land doubled, reaching $100,000 after 5 years.
So let me do the math here. They started with $500,000, and after 5 years, their portfolio is now worth $660,000. Plus, they've got a steady monthly cash flow of $2,500 from their rental properties and an annual income of $5,000 from dividends. That's phenomenal.
This case study is a testament to the power of combining capital gain and cash flow investment strategically. By diversifying their portfolio, leveraging their cash flow to reinvest, and playing both the short and long game, this investor achieved substantial wealth growth and created a reliable income stream.
This is truly inspiring. It highlights how a well-thought-out strategy can lead to remarkable results.
Absolutely. And remember, this is just one example. The beauty of investing is that there are countless strategies and approaches you can tailor to your unique goals, risk tolerance, and investment horizon.
This deep dive it's been really eye-opening. It feels like we've gone beyond just the basics and really explored the nuances of, building a really robust investment portfolio.
Right.
But before we wrap up, I think it's important to remind everyone that there's no one-size-fits-all approach to investing.
Absolutely. This case study provides a fantastic illustration, but the specific mix of capital gain and cash flow investments that's right for you will depend on your individual circumstances.
Exactly. It all boils down to three key factors:
Mm-hmm.
your financial goals, your risk tolerance, and your investment time horizon.
Right. Let's start with financial goals. Are you primarily focused on aggressive growth, aiming to maximize your wealth as quickly as possible?
Mm-hmm.
Or are you more interested in creating a stable income stream, perhaps to supplement your current income or fund your retirement?
Yeah, that's such a crucial question to ask yourself. Your goals will really dictate the types of investments you prioritize.
Next, consider your risk tolerance. Are you comfortable with volatility, knowing that your investments could fluctuate significantly in the short term, but potentially offer higher returns over the long run? Or do you prefer a more conservative approach, prioritizing stability and minimizing the risk of losses?
Knowing your risk tolerance is essential, especially when it comes to, using leverage or investing in more volatile asset classes.
And finally, think about your investment time horizon. Are you investing for the long haul with decades until you'll need to access your funds? Or are you looking for shorter-term gains, perhaps, to achieve a specific financial goal in the near future?
Yeah, this is where your age and life stage come into play. A younger investor with a longer time horizon might be more comfortable with higher risk investments, while someone closer to retirement might opt for a more conservative approach.
Exactly. And I think, this deep dive has equipped you with the knowledge to understand these core concepts and start thinking critically about building a portfolio that aligns with your unique needs and aspirations.
I couldn't agree more. This whole deep dive has been packed with actionable insights. But before we sign off, I want to leave our listeners with a final thought-provoking question from our source material.
Okay.
What type of investment strategy will you use to achieve your financial goals?
That's a question worth pondering. We encourage you to take what you've learned today, assess your individual circumstances, and start crafting a personalized investment plan that sets you on the path to financial success.
Remember, investing is a journey, not a destination. There's always more to learn, more strategies to explore, and more opportunities to optimize your portfolio.
And we'll be here to guide you along the way with future deep dives, expert insights, and thought-provoking discussions.
So keep that curiosity burning, keep those questions coming, and most importantly, keep investing in yourselves and your financial futures.
Until next time, happy investing.
That's it for today's episode of Wealth Hustle 247. Be sure to follow, like, comment, and share with others. Keep pushing toward your goals, and we'll see you in the next episode.